Hi everyone, today our topic is bonds. Let's dive right in, and as usual I want to spend just a few minutes motivating the subject. I've discovered that bonds is one of those topics throughout the semester that, generally speaking, people come into the course with the least amount of natural interest in. So I do want to take the time to make sure that we all understand why this is such an important subject for all of us. So where do bonds fit into our narrative? We've talked many times, probably ad nauseum at this point, about the fact that finance can be defined as the optimal allocation of scarce financial resources. That includes procurement, deployment, and distribution. Well, it turns out that bonds are actually really important on all three of those dimensions. When companies need to procure capital, bonds are one of the most widely used mechanisms for doing that. We would also say that when people seek to deploy their capital, certainly bonds are one of the investment assets that are considered and often put in portfolios. And I should also add here that bonds are a way of distributing capital. So it very much hits on all three of the subcategories of our definition of finance as the allocation or the optimal allocation of scarce capital. But perhaps even more important, at least in my eyes, we had a discussion the very first day about what drives the wealth of nations, what it is that creates the economic output for countries. And we said that generally and broadly speaking, we can identify at least three input variables that determine economic output in a country. And those three input variables are natural resources, labor capital, and the financial system. Well, bonds and the bond market are a critical component of our financial system and contribute very much to the economic output of any country. Most people don't know this, but the bond market, in terms of dollar volume and the number of entities involved, is actually much larger than the stock market. So let me see if I can show this to you. What I've pulled up here is data regarding the amount of bonds that are outstanding. And for the most recent data that I have, which is Q3 2015, I want you to see that the total amount of bonds outstanding, let me highlight this for us just so we can see it. The total amount of bonds outstanding in the US as of the end of Q3 2015 was $39.5 trillion. $39.5 trillion, and you can see how that breaks down. Roughly 3.7 trillion of that was in the form of municipal bonds, 12.8 in the form of treasury bonds, 8.7 tied up in mortgage-related securities, corporate debts at 8.2 trillion, agency securities at 1.9, and money market at 2.6, and then asset-backed at 1.4. So how does the $39.5 trillion compare to the stock market? Well, if we go and look at the stock market, and what I'm showing you here is what's called the Dow Jones U.S. Total Stock Market Index. They're trying to capture all publicly traded stocks. You can see that they've identified 3,932 individual stocks, and the full market capitalization of all of those 3,900 stocks is $22 trillion. So the bond market is almost double the size of the stock market. Stock market's at 22 trillion, bond market's at 39 trillion. So we can see that in terms of import to the financial system, at least in terms of dollar volume and also the number of entities in the market, the bond market dwarfs the stock market. But also, there's something really, really critical that happens in the bond markets that actually ripples throughout the entire economy. And what that is that interest rates get set in the bond markets. And interest rates have a huge influence on GDP. Now, we don't talk much about GDP in finance classes. It's more of a macroeconomics topic. But GDP is defined as the market value of all final goods and services produced in an economy during a specific time period. It's generally represented using this formula, Y, which is GDP equals C plus I plus G plus NX. What that stands for is consumption plus fixed asset investment plus government spending plus net exports. Now, without doing a super deep dive into the various elements of GDP, let's just make a note here. A lot of people think about GDP as consumer spending plus business investment plus government spending plus net exports. Interest rates have a very, very big impact on that entire equation. Specifically, consumer spending is directly impacted by interest rates in the economy. People buy more plasma screen TVs when interest rates are more favorable. People buy more cars when interest rates are favorable. Likewise, fixed asset investments, which again most people think of as property, plant, and equipment, CapEx, capital expenditures by businesses. Clearly, businesses are more inclined to invest in property, plant, and equipment if they can borrow money at more favorable rates. So at least the C and the I are directly impacted by the level of interest rates in our economy. Might be worth our time to take just a minute to go and look at GDP data. The place to go is the Bureau of Economic Analysis. You can see right here on the front page is gross domestic product. We can come up here and you can actually pull up this, which is a spreadsheet showing you GDP. So here's that spreadsheet, and here's the column that you'd want to keep your eyes on. That's what we would call nominal GDP. And you can see that in the most recent reading in 2015, GDP was at $17.9 trillion for the U.S. If we're interested, we could also dig a little deeper and try to get the breakdown. In other words, we could try to figure out of the $17.9 trillion, how much comes from C, how much comes from I, how much comes from G and in X. So let me pull that up really quickly. Okay, so you can see I've actually pulled up the various components of GDP. Here's the $17.9 trillion. I'm not exactly sure why Q4 is showing 18.1. I'd have to go in and dig a little bit, so forgive me on that. But in the most recent reading that I show in the tables, GDP here is at 18.1 trillion, so let's use that number. You can see of the 18.1 trillion, you can see that 12.4 trillion of that comes from the C, the consumer spending. They break it down by durable goods and non-durable goods and services. You can see that fixed asset investment is at 3 trillion. Government spending is at 3.2 trillion. And net exports is at negative $500 billion or 500 billion. So what's the breakdown, roughly speaking? Consumer spending is 12 trillion. Investment is 3 trillion. Government is a little bit more than 3 trillion. And net exports is slightly negative. So that's a bit of a digression, but I think it's an important one because what we're saying is the wealth of nations, which generally speaking is most commonly measured by GDP, which has some flaws in it. Nevertheless, that is the most commonly used metric for the wealth of nations, and that is directly influenced by interest rates, which are set in the bond markets. Specifically, the interest rates have a big impact on the consumer spending and the fixed asset investment, which happens to be $15 trillion of our $18 trillion GDP. So I'm just trying to show you that what happens in the bond markets is really, really important. This is a very important way that people procure capital. It's another important method that they use to deploy their capital. It's also a way that they distribute capital. It has huge ramifications in terms of how good and robust and efficient a financial system is, and the interest rates that get set in the bond markets have a massive impact on the economic output in a country. Okay, so now that I've tried to motivate the subject a little bit, let me just give us a roadmap for where we're headed in this lecture. First thing I'd like to do is just introduce us to the very, very most elementary basic concepts of bonds. From there, I'd like to move us into a discussion about the risk factors that influence the yields to maturity of bonds. As a part of that, we're necessarily going to need to explore the concept of bond pricing. Once we do bond pricing, I'm going to come back to one of the important risk factors, and we're going to have to learn about a concept called duration. Once we get through all of the technical aspects of bonds, at the end of the lecture, what I want to try to do is to dispel two common myths that seem to persist amongst most people. That is, number one, many people believe that bonds are safe. Now, in their defense, when people say that, I think sometimes they simply mean to say that bonds are safer than the stock market. If that's the assertion, then I have no disagreement. Unfortunately, I think there are a lot of people who do believe that in absolute terms, bonds are safe. So I want to try to prove to you that bonds are not in absolute terms safe, that you can lose money holding bonds, and I'll try to show you an episode in history where that was very clear. The second myth that a lot of people seem to hold is that all bonds are the same. What I've discovered is most people don't even know that there are different categories of bonds, and if they do, they don't understand the differences, and in their portfolios they don't make any distinction. So again, I want to try to show you a moment in history where understanding the differences between the various categories of bonds could have had a very big impact on your portfolio. So let's dive right into the basic characteristics of bonds. What you see here is a very old bond. This particular bond matured in the year 2000, but let's just note from the face of this bond some important attributes when it comes to bonds. First off, notice stamped on the face of the bond is a dollar figure. We call this the face value because it's stamped right on the face. It's also known as the par value. This represents the amount of money that an investor will receive at maturity. So anybody holding this bond when it matured in the year 2000 received $1,000. That's the par value or the face value. Next, notice there's this percentage rate, again stamped on the face of the bond. This percentage rate is known as the coupon rate. So I want to repeat, coupon rates are stamped on the face of the bond. For 99% of the bonds floating around out there, the coupon rate never changes over the life of the bond. So with this bond, it's 8.5%. What that means is every year this bond is going to pay the bondholder 8.5%. So how would you get the coupon payment for this bond? You would take 8.5%, which is the coupon rate, and you would multiply it by $1,000, which is the face value, and then you would just divide it by the number of payments per year. Most bonds pay semi-annually, so to get the coupon payment for this bond, you would take 8.5%, multiply it by $1,000, which if I'm not mistaken is $85, and if it was a semi-annual bond, you would then divide that by 2, which would be $42.50. So that's how you would get the coupon payment. That's the payment that investors would receive every 6 months associated with this bond. Next, notice that stamped on the face of the bond is the maturity. So this bond matures in the year 2000. If you read the fine print down here, you would be able to discover the exact date on which this bond would come due or did come due in the year 2000. So again, at that maturity date, investors are going to receive the face value or the par value. Okay, so we've talked about face value, par value. We've talked about coupon rate. We've talked about maturity date. We've talked about coupon payment. Some of you might be sitting there saying, wait a minute, where is the yield to maturity on this bond? Well, yield to maturity is never printed on the face of the bond, and the reason for that is, unlike the face value, and unlike the maturity date, and unlike the coupon rate, the yield to maturity is actually constantly changing over the life of the bond, because the yield to maturity is not something that you stamp on the face of the bond. The yield to maturity is something that gets set by the markets. So we need to have a conversation answering the question, what determines yield to maturity? The yield to maturity is, by definition, the interest rate that is being demanded by investors in exchange for buying this bond. Another definition of the yield to maturity is the yield to maturity is the average annual return that an investor will earn if they buy the bond at whatever the price is out in the market and hold it to maturity. Let me say that again. Yield to maturity is the average annual return that an investor would earn if she or he bought that bond at the market price and held it to maturity. Now, from what I just said there, you may have picked up on something important related to bonds. There is a correlation between price and yield to maturity. We'll get there in a second. I want to come back to the notion that the yield to maturity, which is not and cannot be stamped on the face of the bond, the yield to maturity represents what the market thinks this bond should pay investors. So we like to think of this as something called the required return. All assets have this. Every asset that trades in the market has a required return. It's simply the return that investors demand in exchange for buying the asset. So what is it that determines the required return? And what I'm about to tell you now applies broadly. So I want you to imagine that you were thinking about buying a bond. Let's say you're thinking about buying a bond from Ford Motor Company. Now, you somewhat understand Ford's past. You understand that they were able to weather the crisis better than GM, better than Dodge, Chrysler, Jeep. Nevertheless, they had to load up on debt. At one point, they had negative equity. They're just now clawing themselves out of a very deep hole. So there is some risk involved with this. Now, if somebody came to you and said, hey, I want to sell you $1,000 face value bond for Ford Motor Company, and you're sitting there asking yourself, well, what return am I going to demand in exchange for this bond? Now, we're not talking about coupon rate. They can put any coupon rate on it that they want. What we're talking about is, what return do you think you should get in exchange for buying this risky bond from Ford? Well, we tend to think that the first element that people put into their equation for required return is something called the real return. This is a theoretical construct. It does not exist anywhere. Let me tell you why it's theoretical. The real return is the prevailing return to an asset that has no risk, assuming that there is no inflation. Hopefully you can see why that's a theoretical construct. First off, there are no assets that have precisely zero risk. Now, there are assets that we believe maybe approximate zero risk, but the real reason why it's a theoretical construct is you will never find an asset existing in the vacuum that is completely devoid of inflation. All assets exist in economies. All economies have some level of inflation or deflation. But nevertheless, here's the reason why that's the first theoretical component of any required return. It's because if you're going to buy a risky asset, you should at least, at a minimum, demand to earn whatever the riskless asset is going to earn in your economy if there were no inflation. That's the baseline. I'm not going to buy a Ford bond if it cannot at least pay me what the riskless asset is earning. So that's why the real return is the first component of any required return. The second component is equally obvious. The second component is what we call the expected inflation premium. All we mean to say here is, when you're thinking about what you're going to demand in exchange for buying this Ford bond, the next question you're going to ask yourself is, what do I think inflation will be over the life of this bond? And if this bond cannot adequately compensate me both for whatever the riskless asset is earning out in the economy and for inflation, I'm not going to buy it. I at least need to get those two rates of return. I at least need to be compensated for whatever the riskless asset is earning, and you at least got to cover inflation. Otherwise, I'm not really gaining any purchasing power. Now, those two elements are often combined whenever we're talking about required returns, and we simply call that the risk-free rate. And the reason that we combine those two things is because, like I said earlier, there are assets that approximate a riskless state. So there are assets that we believe really have almost no risk. What would be a perfect example of this? Imagine a short-term T-bill, like a 28-day T-bill from the U.S. government. It's very hard to imagine that there's hardly any risk associated with a super short-term U.S. T-bill. One of the reasons why we think there's almost no risk associated with that is because 28 days is a super short period of time. Not a lot can go wrong, and we don't believe that the U.S. government could possibly default on its debt, especially in that short of a time frame. And even if the government did get into financial distress, the U.S. government can do something that almost no other bond issuer in the world can do. They can print money if they need to in order to pay their interest. Now, that's not a good way to pay your interest if you're a country. That's certainly going to lead to inflation, which in a way devalues the bond, but nevertheless, it avoids default. But if you think about it, that T-bill exists in the American economy where there is inflation. So when we look at the interest rate on a T-bill, the yield to maturity on a T-bill, we think what we're seeing is some combination of the real rate of return, because it's a riskless asset, plus what investors think inflation will be over that time period of that bond. So the reason we combine the real return and the expected inflation premium is because we think we have a nice proxy for that. And we call that combined element, we call that the risk-free rate. But you're not done. If you're thinking about buying this bond from Ford, there are other risk factors that you need to be compensated for. I hope that everybody can appreciate that risk requires compensation. I have a funny story to tell you about that I don't really want to immortalize in a YouTube video. So if you remind me in class, I'll talk to you about the funny story that demonstrates that risk requires return. But I hope it's obvious. I hope it's something that's axiomatic for people. That yeah, if I'm going to take on more risk, I'm certainly going to demand more return, which is why the third element of all required returns is what we call the risk premium. And this risk premium is specific to the bond, and this is an important point. Those first two components, the real return and the expected inflation premium, which make up the risk-free rate, that should be the same for any asset in the U.S. economy. You take any risky asset, I don't care if it's a stock, I don't care if it's a bond, any risky asset, and you try to come up with the appropriate required return for that asset, the first component is going to be the risk-free rate, but that risk-free rate should be the same for all assets in the economy. Because the real return is not asset specific. The real return is simply the return to any riskless asset in the economy. That holds for any risky asset you'd be thinking about. Similarly, the expected inflation premium is economy-wide. That's not asset specific. So the risk-free rate should be the same for all assets in the economy. Where you get differences, where you get heterogeneity across required returns is in the third element, the risk premium. So if you think about bonds, what are some of the risks specific to bonds? The first one that comes to mind is default risk. There is a risk that Ford might start to incur losses, its cash flows could go negative, and if it's not careful, they may not be able to make their required interest payments. That's what we would call default. So this is a big risk. Almost all bonds possess some level of default risk. Another risk factor that bonds face is called interest rate risk. Now, I have three elements of the required return formula highlighted in red. They are inflation, default risk, and interest rate risk. I'm going to refer to these as the big three risk factors for all bonds. We're not at a point yet where we can talk about interest rate risk. It's a bit of a complex subject, and we need to do some more plowing to get things ready for us to actually start talking about interest rate risk. I'm just simply going to point out that these are the big three risk factors: inflation, default risk, and interest rate risk. I promise you I'll come back and talk about interest rate risk in depth later on. There are other sort of second and third order risk factors. For instance, liquidity risk. There is tremendous heterogeneity when it comes to liquidity across bonds. It's widely known that short-term treasuries have very deep, very liquid markets. There are other types of debt that have very thin, very illiquid markets. So that's another risk factor that has to be considered. There's call risk, right? A bond that is callable is a bond that can be retired before maturity at the behest of the issuer. Let's think for a second about why this presents risk for an investor. Imagine that you bought a bond that had an interest rate of 8.5%. What if you bought a bond that was paying 8.5%? And then market rates drop like we've seen them do since 2008. You might be sitting on a bond paying 8.5% while the market is only offering 3 to 4%. And you're feeling very good about yourself. You're thinking, wow, I have a bond that's paying twice as much as what the market is currently offering. Well, unfortunately, if your bond is callable, that bond is going to get retired because the issuer of your bond is going to realize that they could just go and issue a new bond at 3.5% and use the proceeds to kill the bond that you're sitting on. That would be very bad for you. That would mean that your 8.5% bond goes away and the next best alternative is 3.5%. So that's why there is something called call risk. There's geopolitical risk. What if you buy a bond from Greece and Greece, for whatever reason, defaults on its bonds? And we've seen Greece get close to that over the last few years, which is why I'm using Greece as the example there. We can think of tax risk. Different bonds are taxed differently under the U.S. tax code, and there can be shifts in the U.S. tax code. And there are a host of other second order and third order conditions, but I really want to reiterate the three big risk factors are inflation, default risk, and interest rate risk. Like we said earlier, inflation is not bond specific. Inflation is a risk factor that should be the same for almost all bonds in the economy. However, default risk and interest rate risk, again, we have not defined yet, but those two, any of the risk factors under the risk premium, those are going to be bond specific. In a nutshell, and speaking broadly, any required return, whether you're talking about stocks or bonds, can be considered as simply two elements: the risk-free rate, which has the real return and the expected inflation premium baked into it, plus the risk premium. The risk-free rate should be the same for all assets in the economy, but the risk premium should be specific to the asset that you're analyzing. I really hope you'll remember that, because when we come back and try to value stocks, we're going to return to that definition of required return. Okay, so we said there are three big risk factors: inflation, default risk, and interest rate risk. I want us to think for a second about the impact that movements in these risk factors might have on the yield to maturity, which is also called the required return. I think it's very straightforward that if inflation moves, it's going to simply have a direct impact on the yield to maturity. I took the previous slide and just copied it because I think we want to keep our eyes on this. You can see down here that the expected inflation premium is one of the parts of the required return. So if inflation goes up, yield to maturity is probably going to go up. And if inflation goes down, yield to maturity is probably going to go down. We should make the small but important point, however, when we're talking about yield to maturity, investors are not looking at the current rate of inflation. They're trying to anticipate what inflation will be over the life of their investment. However, current inflation rates always will influence forecasts of inflation, which is why, generally speaking, when you see inflation go up, you will also see interest rates go up. Let me take just a minute and demonstrate this to you. So back in the 70s, inflation flared up and became quite problematic. You can see we went from inflation levels of 6%, and then pretty quickly they jumped up to 11, 10, 10. What I've also put right next to it is the yield to maturity on 30-year treasuries, and I just want you to notice, as inflation goes from 7 up to 12, we also see the yield to maturity on 30-year treasuries go from 8.18% up to 9.03%, and they even get as high as 12%. So as we see inflation getting up to 16%, we see yields to maturity going up. That ought not to surprise us based on what I just showed you in terms of what drives yield to maturity. So I think the impact of inflation on yield to maturity is pretty straightforward. Similarly, I think that default risk and its impact on yield to maturity is pretty straightforward, but I'd like to talk about it briefly. And then, like I mentioned, with interest rate risk, we've got a little bit more work to do before we can really dive in on that. So let's keep that on the table for now, but let's talk about default risk. We have in America a system for measuring default risk, and they are called credit ratings. There are three primary entities, and these are for-profit entities. They are not government entities. These for-profit entities, three of them, that do credit ratings are Moody's, Standard & Poor's, and Fitch. What you see on the screen are the various taxonomies that they use when they're measuring default risk. You can see that generally speaking, anything from BAA up to AAA under Moody's, that's all investment grade. The A levels would be high grade. When you get into the B levels, we would call that lower grade. S&P and Fitch have very similar taxonomies in terms of how they break down default risk. Just a couple of notes here. First off, all bond issuances typically require 2 ratings. The bond market is not going to give you success placing bonds if you don't have at least 2 ratings, because it's super hard. It's super hard for the bond markets to peg a yield to maturity if they don't have some estimate of default risk. So they're going to demand an estimate of default risk. The most efficient way for that to happen is through the ratings agencies. So how it works is, anytime an issuer wants to place a bond out in the capital markets, generally speaking, they have to get ratings from 2 of the agencies. So the issuer initiates the request. They also pay for the rating. Typically, the cost is between $15,000 and $30,000 per rating. So to issue one bond, you're going to need to get two of those, one from two companies. It's going to cost you 15 to 30K for each of those ratings. It's important that we remember that credit ratings only measure default risk. It's not giving us liquidity risk. It's not giving us call risk. It's not giving us interest rate risk. It's just giving us default risk. I hope it goes without saying that a downgrade, for instance, on the S&P schedule, moving from BBB, triple B, down to double B, which would be a very important downgrade because that would move the bond issuance from lower medium grade. What we mean by that is investment grade. If you go from triple B down to double B, you leave the investment grade category and now you're in the speculative, oftentimes called junk bond category. What that means is if S&P did that to you, they perceive that the default risk of your bond has increased. So once a ratings agency actually puts the initial rating out there, it will update it periodically depending on events and changes in the financial health of the issuer. So this is how default risk works. So let's come back to this slide. So what does it mean when we say that a company gets downgraded? For instance, if they go from triple B to double B, what impact should that have on yield to maturity? The default risk has increased as demonstrated by the downgrade from one of the ratings agencies. That should increase the risk premium, which will increase the required return. So in essence, all we're really saying is that if any of these risk factors go up, the yield to maturity should also go up. I want to plow forward and I want to do some of this digging that we need to do in order to understand interest rate risk. In order to get to that point where we can understand interest rate risk, we have to talk about bond pricing. We love to talk about bond pricing in finance because it represents the quintessential financial asset valuation problem. You remember that I've tried to make the argument repeatedly that the value of any asset should be driven by the utility that it offers. Financial assets are unique because financial assets only give one form of utility. You don't eat them, you don't wear them, you don't live in them, you don't drive them. All you get from financial assets are future cash flows. So the value of a financial asset should be a function of the future cash flows, but that brings up four questions. The first question is, which cash flows should we use? The second question is, how do you forecast those cash flows? The third question is, how do we take into account time? And this is what we talked about in the time value of money lecture. And then the fourth is, how do we take into account risk? Now, I told you we were largely going to leave that subject till the last lecture of the semester, but we'll touch on it briefly here. Well, here's the short answer to all of those questions. Which cash flows and how do we forecast them? That's easy. It's just the principal and the interest, and it cuts off at a certain date known as maturity. So one of the reasons that we love to value bonds is because the cash flows are so easy to map out. It's just the principal and the interest. We know what they are and we know how to forecast them. How do we take into account the time? Well, again, hearkening back to our discussion on time value of money, we're going to use that cornerstone, seerstone, keystone formula, and we're simply going to find the present value of each of those cash flows that we map out. The last question is, how do we take into account risk? Well, there's a reason why I'm keeping a copy of this other slide in front of us. Notice that the required rate of return captures all of the risk that we think is contained in this particular asset. So what that means is if we use the yield to maturity as our discount rate, we will be, to the extent possible, we will be capturing all the risk that we can measure in this asset. So we've answered all the questions, and that's why we love to price bonds, because they represent sort of the simplest, quintessential financial asset valuation problem that exists. Much, much more challenging, a lot more ambiguity and uncertainty when we get into stocks. Here is the basic idea of how you price a bond. Map out the cash flows, so you're going to have your first coupon payment, your second coupon payment, up until maturity, so I'm just using capital M to represent maturity. At maturity, you'll get your last coupon payment. You'll also get the face value of the bond. Then we're just going to use the cornerstone, keystone, seerstone formula to find the present value of each one of these future cash flows using the yield to maturity as our annualized stated rate. Keep in mind, though, the yield to maturity is an annual stated rate. To get the periodic rate, we would need to divide that by the number of payments per year. So how are we going to get each coupon payment? Well, remember, that's par value times the coupon rate, both of those stamped on the face of the bond, divided by the number of payments per year. The R, or our discount rate, is going to be the yield to maturity divided by the number of payments per year, and the face value is just the par value, which is stamped on the face of the bond. Now, we could mathematically shorten this so that we don't have to write out this in a laborious fashion. If we wanted to use the shortcut method, we could just use the sigma, which means sum. So all we're saying here is take the cash flow in each period t. So that means right here, t starts at 1 and then ends at maturity. So for each period starting in 1 and going to maturity, take the cash flow and divide it by 1 plus the periodic rate, which is the yield to maturity divided by the number of payments per year, and just raise it to whatever period out you are in. So this is just mathematical shorthand for the longer version up here. So let's go and look at a simple example and make sure we're comfortable with how to price bonds. So what I have here is I have a very simple bond. Its par value is $1,000. The annual coupon rate is 6%. It's going to make 2 payments per year, which means it's a semi-annual bond. The annual yield to maturity is 4%, and there are 5 years to maturity. Well, again, here's the idea. We want to map out the cash flows and discount each of those cash flows back using our fundamental time value of money formula to calculate the present value. So what I've done here is I've calculated the coupon payment each period. Since it's a 6% annual coupon rate, that's $60 per year if we're talking about a $1,000 par value. We take the $60 and divide it by the 2 payments per year, which gets us $30 for each coupon payment. This is a 5-year bond, and there are 2 payments per year, which means there will be 10 periods. There's the final coupon payment right there at maturity. We will also get the par value at maturity. So if we map out the cash flows in each period, those are right here in column E. Then what I'm going to do is I'm going to take each cash flow and divide it by 1 plus the discount rate, which is going to be the yield to maturity divided by 2, and I'm going to raise it to the number of periods. So for instance, right here, what I'm going to do is I'm going to take $30 and I'm going to divide it by 1 plus 4% divided by 2, so in other words, 1 plus 2%. And since we're in the first period, that will simply be raised to 1. And you can see that's exactly what I've done. I've taken E10, which is the cash flow. I've divided it by 1 plus E6, which is the yield to maturity, divided by D6, which is the number of payments per year, and I've raised that to 1, which is the period. So I just do that for all of these cash flows. You can see that this passes our sanity check. If the cash flow, the nominal cash flow, is the same, the further out in time that we go, the present value should be getting smaller, which we see. Once I've done that for all of the cash flows, I simply add them up, and that gives me the price of the bond. There is a faster way to do this. You could simply use the PV function in Excel. The rate would be the yield to maturity divided by the number of payments per year. N per is the total number of periods, which would be the years to maturity times the number of payments per year. The payment is going to be the regular coupon payment. Par value times annual coupon rate divided by number of payments per year. Future value is going to be the par value of the bond, and all of these payments are happening at the end of the period, so I can just close up the formula. You can see that we get the exact same answer that we would have gotten doing the longhand version of this, but it's negative. I hope that makes sense to everybody. What you told Excel is, you said every period I'm going to get positive cash flows of $30, then at the very end I'm going to get a big lump sum of $1,000. Excel assumes that you must be wanting to know the price. If you're getting all of these positive cash flows in the future, it's going to tell you the price of those today, and price is always negative. So there are a few key points that we want to take away from this bond pricing discussion. The first key point is I want you to notice, and let's look at the shorthand formula. What is the relationship between price and yield to maturity? We'll notice that yield to maturity is in the denominator on the right-hand side. What that means is there is an inverse relationship between yield to maturity and price. If yield to maturity goes up, that's going to decrease the price of the bonds. So that's the first key point that I need you to take away from our bond pricing discussion. There's an inverse relationship between yield to maturity and price. I also hope that you noticed over here that the coupon rate of this bond was above the yield to maturity. What that means is the bond is paying a higher interest rate than the market thinks it needs to. If the bond is paying a higher rate than the market thinks it needs to, this is a very attractive bond, and it's going to trade at a premium. So another key point when it comes to bonds is the price will be above the par value if the coupon rate exceeds the yield to maturity. If, however, we reverse that, so now I'm going to put the yield to maturity up to 8%, you will see the opposite. Now the market thinks that this bond should be paying 8, it's only paying 6. That's not an appealing bond. In order to attract investors, it's going to have to sell at a discount. So the next key point is price will be below par value if the coupon rate is less than the yield to maturity. You may have been able to guess then that the price will equal the par value if the coupon rate equals the yield to maturity. Let me briefly demonstrate that to you. I'm simply going to set the annual yield to maturity equal to the coupon rate, and notice that the price equals the par value. I want to also make a note about what's called clean and dirty prices. So when we show you how to price a bond, we always do so in an environment that's very unrealistic. We always assume that the bond is being bought or sold immediately following a coupon payment. But typically that's not what happens. Typically bonds are bought and sold in between coupon payment dates. Excel can handle this, but you need to understand the difference between clean and dirty prices. So I want you to assume that there's a bond and it's going to be sold on February 15th, 2016. The maturity date is April 15th, 2025, and it's a semi-annual bond. So what that means is this bond makes coupon payments on April 15th and October 15th. So down here I've just noted, if the bond is going to be sold, and we're going to call that the settlement date, if the bond is going to be sold on February 15th, 2016, then the last coupon payment was October 15th of 2015, and the next coupon payment is April 15th of 2016. The settlement is, like we said, in between the last coupon payment and the next coupon payment. So here's the problem. When somebody sells this bond, the next coupon payment, the full next coupon payment, is going to go to the new buyer of the bond. But the new buyer of the bond doesn't deserve that full coupon payment, because the new buyer of the bond is only going to own it from February to April. The old owner of the bond had it from October of 2015 to February. Whatever that time period is, they should get paid the interest for that. We call that accrued interest. The basic idea is the old owner of the bond deserves to receive the interest for the time during which she or he held the bond. But the problem is, if they sell the bond on February, they're not going to get any of the interest. All of the interest is going to go to the new buyer. So what happens is, in Excel will calculate the clean price of the bond. This is the price not including accrued interest. It's a very simple formula. All you do is type in price, and it's going to say, well, what's the settlement date? And you just give it the settlement date. What's the maturity date? Okay, what's the annual coupon rate? What's the yield to maturity? What's the redemption? So redemption is simply the amount per $100 of par value to be paid at maturity. So it's easiest if you just put in 100, and I'll explain what the output looks like. Then it says, what's the frequency? For semi-annual, you put in 2. And then it says, what's the basis? I've outlined the taxonomy for basis here. Turns out that there are different bases for different bonds in America. If you put in a 0, that assumes 30 days per month and 360 days a year. If you type in a 1, it's going to use the actual number of days per month and the actual number of days per year. If you put in a 2, it's going to use the actual number of days in a month, but assume 360 days per year. If you type in a 3, it's going to assume the actual number of days in each month, but it's going to assume 365 days in a year. I'm going to use that third convention. Okay, when I hit that button, it's going to spit out 89.075994. This is how bond prices get quoted. This is the percentage of par value that the price should be. So if it is a $1,000 par value, then the price should be 89.075994% of that. So on a $1,000 par value, the price would be $890.76. But that's a clean price. It doesn't include accrued interest. So the person buying this bond should be required to pay the clean price plus whatever the accrued interest is from the last coupon date up until the settlement date. So down here I've calculated that. So what I've said is the last coupon date was October 15th, 2015. The next coupon date is April 15th, 2016. Now we can figure out how many days are in that coupon period by simply taking the next coupon date minus the previous coupon date, and you can see there are 183 days in that coupon period. Well, how many days will have elapsed from the last coupon payment to the settlement date? To get that, we would simply take the settlement date minus the last coupon date. So what does that mean? Of the total coupon period from October 15th, 2015 to April 15th, 2016, there are 183 days. 123 of those days will have elapsed when settlement occurs. That represents 67.4% of the period. Now, what's the total coupon payment? Let's think about the total coupon payment. The total coupon payment is 3.5% times $1,000, but this is semi-annual, so we have to divide that by 2. So the total coupon payment is $17.50. What we're saying is 67.4% of that next coupon payment should go to the old owner. We call that accrued interest. So we take 67.4% of $17.50. We call that accrued interest. You would tack that on to the clean price that Excel gives you, and that would give you the dirty price. The dirty price is what the new buyer would actually pay to the old owner. I hope you can see that that dirty price has two components. It's the clean price, the price of the bond on settlement, plus the accrued interest, all of the interest built up from the last coupon payment to the settlement date. It's a little bit of minutia, but I want you to at least be exposed to that. But I want to come back here to the key bond pricing points. Above all else, you must remember that there is an inverse relationship between yield to maturity and bond price. You need to remember that when the yield to maturity is below the coupon rate, that's an attractive bond and its price will be above its par value. However, if the coupon rate is below the yield to maturity, that's not an attractive bond. It will have to sell at a discount. Its price will be less than par value. And if the price equals, and if the coupon rate equals the yield to maturity, the price will equal par value. Okay. We've finally done the heavy lifting that we needed to do in order to build the framework to talk about interest rate risk, which we've kept on the table through this whole lecture. So let's just very quickly ask ourselves, now that we know how to price bonds, now that we've had a very long conversation, what impact will the various risk factors have when it comes to bond prices? So if inflation increases, what's the likely impact? Well, if inflation increases, that should drive up the yield to maturity. Pushing up the yield to maturity will pull down the price. Similarly, What would happen if a company got downgraded? So what if the bonds for Ford got downgraded from triple B to double B? Well, that means that default risk would be increasing, which would drive yield to maturity up, and the price would go down. So you're probably sitting there saying at this point, okay, I get it. So if interest rate risk increases, then the yield to maturity will go up and the price will go down. And I'm sorry, that's not exactly how it works. Here is the definition of interest rate risk. Interest rate risk measures how much price movement will occur given a specific change in the yield to maturity. What I mean by that is you now understand that if yield to maturity moves, there will be an inverse movement in the price. But what you don't know is how big will that price movement be. And that's where interest rate risk comes in. The best visual representation I can give you of interest rate risk is to think of interest rate risk as the length of the lever in the teeter-totter that shows the relationship between yield to maturity and price. So high interest rate risk would mean there's a very long lever. So if there's a bond with abnormally high interest rate risk and the yield to maturity moves even slightly, you're going to get massive price swings. However, if a bond had low interest rate risk, and again, I'm asking you to visualize interest rate risk as the length of the lever between price and yield to maturity. So if a bond has very low interest rate risk, you might get pretty big swings in yield to maturity and you wouldn't see much price swing. So again, interest rate risk is the length of the lever. It tells you how much price movement will occur given a change in the yield to maturity. So let's talk through this just a little bit. So it turns out that we have a very commonly used measure for interest rate risk, and it is called duration. Let's define duration, then I want to show you how it's calculated. I will not ask you to calculate duration. I believe that's sort of beyond the scope of the class. This is an intro class. Duration is getting to be a more intermediate and advanced concept, but I want you to at least intuitively understand it. And I also hope that by seeing the math, that's going to help you get your mind around it a little bit better. By definition, and remember, duration is the measure of interest rate risk. It tells you the length of the lever. By definition, duration is the weighted average time that it takes to receive the present value of the promised future cash flows from a bond. That's a mouthful. I think as I show you the math, it'll make sense. At this point, just understand that long duration represents high interest rate risk. So long duration represents this setup right here. Short duration would represent this type of inverse relationship, a very short lever. Let me walk you through the steps to calculating duration. The first step to calculating duration is to simply map out the payment periods. If it's a 5-year bond with 2 payments per year, you're going to have 10 periods. Second step, map out the cash flows each period. That's easy. It's just the principal and the interest. Third step, determine the present value of each of the cash flows using our cornerstone, keystone, seer stone formula. Fourth step is calculate the price of the bond. We could summarize steps 1 through 4 and simply say, calculate the price of the bond. But you need to do it the long way. Fifth step, determine the percentage of the bond price that is received each period, and we're going to call this the weight, and I'll show you this in just a second. Step number 6, take those periods that you mapped out in step 1 and translate them into years. Step 7, multiply each year by its respective weight. The last step is to sum all of the products that you calculated in step 7. It looks like a lot, but it's really not. So let me show this to you. Right here, I've taken the bond that we started with when we started looking at bond prices, And let's remember, what are the steps to calculating duration? First step, map out the number of payment periods. Here they are, 1, 2, 3, 4, all the way through 10. Remember, it's a 5-year bond, 2 payments per year. Step 1, check mark. Step 2, map out the cash flows each period. Well, remember, here are the coupon payments. It's a 6% coupon rate, but 2 payments per year. So there are semi-annual coupon payments of $30. But we also have the $1,000 par value at maturity. So here are the cash flows each period. Step 2, check mark. Step 3, use the fundamental time value of money equation to find the present value of each of the cash flows. But remember, your discount rate should be your yield to maturity because that captures all the risk. So your discount rate will be your yield to maturity divided by the number of payments per year. So we're going to use that equation just like we did when we priced the bond, and we're going to calculate the present value of each of the cash flows. Step number 3, check mark. Step 4, calculate the price of the bond. We get the price of the bond simply by adding up the present values of the individual cash flows, and we get a price of $1,089.83. Step 4, check mark. Step 5, determine the percentage of the bond price received each period. What we're saying is this. That's the total price of the bond, $1,089.83. That's the sum of all of these present values. I just want to know what percentage of that is coming from each period. So I'm just going to take the present value of each of the cash flows and divide it by the total price of the bond. That will tell me what percentage of this bond price, which is the sum of all the present values, what percentage of that price is coming in each period. We're going to call that the weights. So I've done that for each period in this column. Step 5, check mark. Step 6 is to translate the periods into years. So this first period is actually a half a year. At the end of the second period, that will be the end of the first year. The end of the third period will be 1.5 years, fourth period 2 years, all the way down, and we can see that the end of the 10th year represents the 5th year. Step 6, check mark. Step 7 is I'm going to multiply the weight by the year. 2.7% of this bond's price is being received in the first period, which is 1/2 of a year. So I'm going to multiply the weight by the year, and I'm just going to record that product. 2.6% of the price of this bond is being received at the end of the first year. I'm going to multiply the weight by that year, and maybe I should make this an extra decimal place so we can see a little better. So I do that. I multiply the weight by the year for all of the periods. Step number 7, check mark. Duration then is simply the sum of the products. What it tells you is the weighted average time that it takes to receive the cash flows from this bond in present value terms. The weighted average time that it takes to receive the cash flows from this bond in present value terms. It's a nice measure of the interest rate risk of a bond. Key points about duration. So first off, duration is a measure of the interest rate risk of a bond. But we need to understand what drives duration. I hope it's obvious that the first biggest driver of duration is simply time to maturity. If I make this a 7-year bond instead of a 5-year bond, you can see that duration increased to 5.9. So again, it goes from 4.42 to 5.9. So one of the biggest drivers of duration is time to maturity. The second big driver of duration is coupon rate. And there's an inverse relationship between coupon rate and duration. Specifically, lower coupon rate increases duration. I'm going to make the coupon rate 0. I'm going to check your comprehension. If I make the coupon rate 0, I want you to think for a second about what's going to happen to this table right here. And because of what's going to happen to this table, I want you to think about what will happen to the weights. If I make this a 0 coupon bond, what will happen to those weights? And therefore, you might be able to guess the duration of this bond without me even calculating it. Take a second and think about that. And I'm going to hit the enter button here. And as you may have guessed, all of the cash flows zero out until the last period. So 100% of the value of the bond will be received in the last year, which means the duration will just equal the years to maturity. What I want you to see is lower coupon rate drove the duration out. So there are some key points related to duration. First off, it's a measure of interest rate risk. It tells you the length of the lever. Second, longer duration comes from two things: longer time to maturity and lower coupon rate. And what does longer duration mean? Longer duration translates into bigger price swings when yield to maturity moves. Let me show this to you. Okay, so I want to demonstrate to you that duration represents the length of the lever. We know that if the yield to maturity changes on a bond, the price of that bond will change. So for instance, if yield to maturity goes down, price should go up. So I'm going to take our original bond, which was a 6% coupon rate and a 4% yield to maturity with 5 years to maturity. I'm going to keep everything the same about this bond, except I'm going to drop the yield to maturity by 1%. We know the price will go up. We don't know by how much, but we do have a reading on duration. 4.42 is a moderate duration. We expect a moderate price swing. I'm going to hit the enter button, and you can see that the price of this bond has gone up by $48.51, which is a 4.45% swing. What I want you to now see is, if this was a longer duration bond, we would get a bigger price swing. That's exactly what duration tells you is the length of the lever, interest rate risk. So I'm going to make this a longer duration bond. Comprehension check. How could this be a longer duration bond? Well, we could drive the time to maturity out, so let's do that, and let's make it a 0 coupon bond. I need you to remember this number, 4.45%. It's going to go up. So let's make it a 7-year bond instead of 5. And let's make it a 0 coupon bond. Okay, so we drove the duration up from about 4 to 7, and I want you to see that the swing in the price of the bond is now 7% instead of 4.5%. So that's the key point of duration. The longer the lever, the longer the duration, the bigger the price swing if we get a move in the yield to maturity. The last key point to make about duration is duration declines over the life of the bond. What I mean by that is, if you think about what drives duration, time to maturity drives duration and coupon rate drives duration. Well, what happens over the life of a bond? The coupon rate doesn't change. It's stamped on the face of the bond. And the time to maturity decreases as you approach maturity. So that's why I said earlier when I posed this question back here, how do risk factors affect price? And we said, oh, well, if inflation goes up, yield to maturity goes up and price goes down. Fine. We said if default risk goes up, if your bond gets downgraded, default risk goes up, required return will go up, yield to maturity will go up, price will go down. Fine. But we would never say interest rate risk just went up, therefore the yield to maturity is going to go up and the price is going to go down. We would never talk that way. Because interest rate risk, generally speaking, only ever declines over the life of the bond, because remember that interest rate risk measured by duration is driven by time to maturity and coupon rate. Coupon rate doesn't change and time to maturity only decreases, so duration declines over the life of the bond. So I just want to reiterate, the big three risk factors: inflation risk, default risk, and interest rate risk. Two of them fluctuate: inflation risk and default risk. And as they fluctuate, that will move the yield to maturity. But interest rate risk won't really fluctuate. It will only steadily decline over time. But the reason that it matters is it tells you how big the price swing is when you get a move in the yield to maturity. And even though it doesn't fluctuate, it is still a component of the risk premium. So a bond that gets issued with bigger interest rate risk will have a higher yield to maturity. That partly explains why long-term bonds typically have higher yields to maturity, because they have higher or longer duration, which means more interest rate risk. Okay, now that we've done a lot of heavy lifting with bonds, I want to come back to the myths, and this is how I want to close the lecture. Remember, we said that there were two myths that seem to be pervasive regarding bonds. The first one is that bonds are safe. The second one is that bonds are all the same. Let's tackle the first myth. So in the late 70s and early 80s, America found itself suffering from massive stagflation. The hallmarks of stagflation are a stagnant economy, meaning GDP isn't really expanding, and yet you have double-digit inflation. It's a very, very bad state for an economy to be in. What impact should this have on yields as inflation starts to rise? Will the impact be broad or bond specific? Well, let's think about this. As inflation starts to rise, that's a changing risk factor. So that means that investors' expectations for inflation will probably increase. If expectations for inflation increase, that's probably going to increase the yield to maturity. Now, will it be broad or bond specific? Remember, we made the point earlier that I hope you'll remember. The risk-free rate should be the same for all assets in the economy. When investors are thinking about inflation, that shouldn't be bond specific. That's an economy-wide measure. So what should be happening during this episode is yields should be rising sort of across the board. So let's go look at the data on this. If you look at the 1970s, you can see inflation really starting to tick up. We go from 7 to 11. We peak out at 16. You can also see that the yield to maturity on treasuries is gradually increasing until it also peaks out at about 12.4%. So sure enough, inflation increases and we see similar increases in yield to maturity in this treasury market. You would see the same thing, by the way, if you looked at other types of bonds. Well, I want to ask myself this question. What if I bought a 30-year treasury bond on this date when the yield to maturity was at 8.18%, and then I held it for 3 years, and I sold it on this date when the yield was 12.4%? Well, what I've done here is I've said, all right, let's assume we bought a $1,000 bond when the yield to maturity was 8.18%, and I'm going to assume when we bought it, it was newly issued, and most newly issued bonds have coupon rates very close to their yield to maturity. So I'm going to assume that the coupon rate equals the yield to maturity. We learned earlier that that means the price should equal the par value. We're assuming it's a 30-year treasury. You now know that if it's a 30-year treasury, that means there's very long duration. So we're going to get a big price swing. Well, we hold it for 3 years. So now there's only 27 years to maturity. The coupon rate doesn't change, the par value doesn't change, but the yield to maturity has spiked as a result of inflation. The price of the bond has dropped to $672.90. We knew there would be a big price swing. The interest rate risk was high. The duration was long because of the long time to maturity. So that's a drop in price of $327.10. Now, we did receive 3 years worth of coupon payments, and each of those coupon payments were $81.80. So we have 3 years worth of coupon payments to net against our capital loss. If you net the capital loss against your coupon payments, you lost $81.70. What does that mean? Your net total holding period return over the 3 years was 8.17%. So for 3 years you held a bond and your total holding period return was negative 8.17%. I want you to see bonds are not safe. They are safer than stocks. They are less volatile than stocks, but you can lose money in bonds. And what's the recipe for disaster in bonds? So the recipe for disaster in bonds is to hold long-term bonds because they're going to have high interest rate risk, long duration, when interest rates are about to go up. If you own a long-term bond that has long duration right when interest rates are about to go up, you're going to get crucified and you're going to have negative holding period returns. I think this is an interesting case study because we need to ask ourselves, where are bond rates right now as I record this video? Bond rates are at historically low levels. So what would be a recipe for disaster right now? Go buy long duration bonds, so bonds with long times to maturity and low coupon rates, and let interest rates, let yields to maturity spike, and you'll see yourself incur some really damaging losses in your bond portfolio. So that's the first myth. Bonds are not safe, and we need to understand how we can lose money there. The second myth is that all bonds are the same. Most of us remember this. We all lived through it. In 2007 and 2008, real estate started to soften and collapse, and there were a lot more triggers for the financial crisis, and maybe if we have time in a subsequent lecture, I'll walk through some of the triggers and some of the reasons that our economy collapsed. But for now, let's give the very simplified version. In 2007 and 2008, real estate collapsed, which triggered a wave of defaults. And these bond defaults affected bonds that investors widely assumed were safe. So AAA rated bonds, specifically MBS and CDO, dropped precipitously in price on the heels of the real estate collapse. Credit default swaps got obliterated, at least people on one side of the credit default swaps. Money market instruments even got hit, specifically when Lehman Brothers went bankrupt. They defaulted on some of their money market instruments. So there was a wave of defaults that hit the market on the heels of the real estate collapse. This led to something of a widespread default panic, and I'm not going to go into great depths on this. But essentially, in all of the various bond markets, AAA rated corps, AAA rated MBS, BBB rated corps, agency securities, money market instruments, munis, there was like a massive default panic. Well, what would the impact be of a massive default panic? And would it be broad or bond specific? Well, if default risk is going up, we know it should drive the yield to maturity up. But notice, this is a part of the risk premium. Default risk is not the same for all of the bonds in the economy. Specifically, remember that we noted there's one type of bond that investors generally perceive to be default free, and that's treasuries. So what might this mean? During the crisis, different types of bonds were going to see a different impact on their yield to maturity. Bonds subject to higher default risk probably were going to see their yields to maturity spike, while bonds that had almost no default risk might see their yields go the other way. Why is that? Well, it's because there's a flight to safety. And during the flight to safety, you see demand spike. If demand spikes, prices will go up. We know there's an inverse relationship between price and yield, so yields will go down. Well, in order to show you the data, we need to talk for just a second about how you can classify bonds. There are at least three ways that you can classify bonds. You can classify bonds by the issuer. Was it issued by a sovereign government? Is it issued by the U.S. government, by the English government, by the Brazilian government? Those are all sovereign bonds. Or was it issued by municipal governments? The state of California, the county of Salt Lake County, the city of Detroit. Those are municipal bonds. Was it issued by a corporation? Ford Motor Company, Apple, Microsoft. Was it issued by an agency? So agencies are entities that were created by the U.S. government but not technically owned by the U.S. government. Back in the day, this was Fannie and Freddie. So anyways, that's just the first axis on which you can categorize bonds. The second axis is credit rating. Is it AAA, BBB, BAA? So that's just another axis on which you can categorize bonds. The third axis would be the attributes. Is it a callable bond? Is it secured and collateralized? Is it zero coupon? Is it asset-backed? So those are just attributes on which we can categorize. The reason this matters is
I hope you can see, if you can categorize on 3 axes, you can literally come up with hundreds of bins in which you could place each bond. And those bins are all going to respond differently to this default panic, because each of the bins are going to have a slightly different profile when it comes to the default risk. So let's go see how this played out in the bond market. What we're going to do is we're going to compare the impact of the crisis on 2 different bonds. First off, let's look at BAA corporate bonds. Let's assume that you buy a BAA corporate bond on January 1st of 2008 at 6.54%, and you sell it 2 years later at 8.43%. To make life easy, we're going to assume that the coupon rate equals the yield to maturity, and we're going to make it a long-term bond. Again, that's going to give it a long duration, a big price pop. Well, as the yield to maturity spikes because default risk panic is sweeping through the market, and this is a bond that is subject to default risk, your price is going to drop from $1,000 to $798. That's capital losses of $201.99. We net that against 2 years worth of coupon payments, and your total loss would have been $71.19. That represents a net loss of 7.12%. How would you have fared, however, if you would have bought a 30-year treasury during the same time period? So now you're buying a treasury at 4.33 and selling at 2.87. Again, I'm assuming the coupon rate equals the yield to maturity at issuance. It's a 30-year bond. 2 years later, the yield has dropped to 2.87. Your price has popped to $1,279.65. So that's a capital gain of $279.65. We need to add 2 years worth of coupon payments. Your total gain would have been $366.25. Your total return over the 2 years would have been 36.62%. This was a moment where not all bonds were the same. Bonds that were subject to default risk got obliterated. Total losses are 7.12%, whereas bonds that were immune from default risk actually really won and gained 36.62%. So what was the net swing in your portfolio if you understood the differences between the bonds and if you understood the risk factors that drive the bonds? The net swing was about 43%. So again, what are the 2 myths? Bonds are not safe. You can lose money. I hope you now understand why and how. I hope you understand the recipe for disaster. And also, the other myth is that bonds are the same. They are not the same. I tried to show you that in the financial crisis of 2008, it mattered whether or not you understood that. BAA bonds got hammered. Treasuries were darlings. Well, I hope that this has been helpful. I will see you in class.